Good day, this is Bernadette M. Magaling and I'll be discussing segment reporting, specifically its definition and nature, types, identification of reportable segments, and the presentation and disclosure requirements. First, let me define segment reporting. Segment reporting is the disclosure of certain financial information about the products and services an entity produces and the geographical areas in which an entity operates. The purpose of such disclosure is to enable investors and users make better assessment of each business activity, leading to the understanding of the entity as a whole. Philippine Financial Reporting Standards 8 sets out the requirements for disclosure of information about operating segments. The core principle of segment reporting is as follows. An entity shall disclose information to enable users of financial statements to evaluate the nature and financial effects of the business activities in which it engages and the economic environment in which it operates. So what is operating segment, by the way? An operating segment is a component of an entity that engages in business activities from which it may earn revenue and incur expenses, including revenue and expenses relating to transactions with other components of the same entity. It is also a component of an entity whose operating results are regularly reviewed by the entity's chief operating decision maker to make decisions about resources to be allocated to the segment and assess its performance, and for which discrete financial information is available. The chief operating decision maker identifies a function and not necessarily a manager with a specific title. This function is to allocate resources to the segments and assess their performance. The chief operating decision maker may be the entity's chief executive officer, chief operating officer, or a group of executive directors depending on who within the organization is responsible for the allocation of resources and assessing the performance of operating segments. At this point, we will now proceed to different types of segments, the business and the geographical segment. A business segment is a distinguishable component of an enterprise that is engaged in providing an individual product or service or a group of related products or services and that is subject to risk and returns that are different from those of other business segments. Factors that should be considered in determining whether products or services are related includes the nature of the products or services, the nature of the production processes, the type or class of customers for the products or services, the methods used to distribute the products or provide the services, and if applicable, the nature of the regulatory environment. For example, banking, insurance, or public utilities. While geographical segment is a distinguishable component of an enterprise that is engaged in providing products or services within a particular economic environment and that is subject to risk and returns that are different from those of components operating in other economic environments. So the factors that should be considered in identifying geographical segments include the similarity of economic and political conditions, relationships between operations in different geographical areas, proximity of operations, special risk associated with operations in a particular area, exchange control regulations, and the underlying currency risks. With this, it can be said that the two differs with what they focused on. The business segment focuses on the product or service, while the geographical segment focuses on the economic environment or the place where the company operates. So how do companies identify operating segments? So these are identified based on the components of the entity that are considered to be important for internal management reporting purposes. Reporting of segment information is seen through the eyes of management, and users would wish to see the business as the chief operating decision maker sees it. However, it is important to note that not all segments are reportable. the entity will report only those segments that will meet any of the following quantitative thresholds. Number 1. The segment revenue including both sales to external customers and inter-segment sales or transfers is 10% or more of the combined revenue, internal and external, of all operating segments. Number 2. The absolute amount of profit or loss of the segment is 10% or more of the greater in absolute amount of the combined profit of all operating segments that reported a profit and the combined loss of all operating segments that reported a loss. And number 3. The assets of the segment are 10% or more of the combined assets of all operating segments. Operating segments that do not meet any of the quantitative thresholds may be considered reportable and separately disclosed on a voluntary basis if management believes that information about the segment would be useful to the users of the financial statements. To further explain, here is an illustration. Revenue, profit or loss, and assets for each operating segment are as follows. Segment A has the revenue of 16 million, profit of 1,700,000, and assets of 25 million. Segment B has 13 million, profit of 500,000, and assets of 11 million. Segment C has 6 million, revenue, loss of 1 million, and an assets of 3 million. Segment D has 3 million revenue, 200,000 profit, and 2 million assets, while Segment E has 2 million revenue, loss of 100,000, and assets of 4 million with a total revenue of 40 million, profit of 1,300,000, and an asset of 45 million. Now, we will determine what segments are reportable based on revenue. The first thing we need to do is to multiply the total revenue of 40 million by 10% to determine the 4 million basis, which A, B, and C are reportable segments because the revenue associated with each of these segments is at least 4 million, which is 10% of the total revenue of 40 million. D and E, on the other hand, are not reportable segments because revenue of such segments is less than 10% of the total revenue, as shown here in the table wherein the revenue of segment A, B, and C are 16 million, 13 million, and 6 million respectively, which is at least 4 million and are reportable, and the segment D and E have the revenue of 3 million and 2 million respectively, which are less than 4 million and not reportable. Next is based on segment assets. So the first thing we need to do again is to multiply the total segment assets by 10% to determine the basis, which is 4,500,000, in which A and B are reportable segments because assets of such segments are at least 4,500,000, which is 10% of total segment assets of 45 million. C, D, and E, on the other hand, are not reportable segments because their assets are less than 10% of the total segment assets, as shown here in the table wherein the assets of segment A and B are 25 million, 11 million respectively, which are at least 4,500,000 and are reportable, while the assets of segment C, D, and E are 3 million, 2 million, and 4 million respectively, which are less than 4,500,000 and are not reportable. Next is based on profit or loss. Applying the criterion of 10% of profit or loss is somewhat complicated because some segments have profit and others have losses. So the profit must be combined and the losses must be combined to determine which is greater between the two first. So as shown in the table, the total profit is 2,400,000 and total loss is 1,100,000. Because the total profit figure is greater than the total loss figure, which is 2,400,000, it will be the basis for identifying reportable segment. Hence, any segment with profit or loss of 240,000, 2,400,000 times 10% or greater qualifies as reportable segment. Therefore, A, B, and C are identified as reportable segment under the profit or loss criterion. Shown here in the table wherein segment A has a profit of 1,700,000, segment B has a profit of 500,000, and segment C a loss of 1 million, which are at least 240,000 and are reportable. And segment D and E on the other hand has a profit of 200,000, E and loss of 100,000, which are less than 240,000 and are not reportable. It can be therefore conclude that A, B, and C are identified as reportable segments. D and E are not reportable segments because they do not meet any one of the 10% quantitative thresholds for identification as reportable segment. Thus, D and E may be combined for reporting purposes, but A, B, and C, being reportable segments, shall be disclosed separately. Overall size test or the 75% threshold. If the total external revenue of reportable operating segments constitutes less than 75% of the entity external revenue, additional operating segments shall be identified as reportable segments even if they do not meet the 10% quantitative thresholds until at least 75% of the entity external revenue is included in reportable segments. So the aggregation of segments has a big impact on the overall size test, but we will define what this is first. So 2 or more operating segments may be aggregated into a single operating segment if the segments have similar economic characteristics and segments share a majority of the following 5 aggregation criteria. To further explain, here is an illustration. An entity has no intersegment sales and has the following operating segments with their corresponding revenue. Segment 1 has a revenue of 2,400,000, which is 30% of the total revenue. So based on the revenue criterion, the reportable segments are segments 1, 2, and 3. Because as shown in the column of the percentage, the only segments that is above 10% are segments 1, 2, and 3, and the remaining segments are not reportable. So now, assume that the remaining segments did not also satisfy the other criteria of profit or loss and the total assets. So, the total external revenue of the reportable segments is as follows. Segment 1 has a revenue of 2,400,000, 30%, segment 2, 1,600,000, 20%, and segment 3, 1,200,000, 15%, with a total of 5,200,000 and percentage total of 65%. It can be observed that the total percentage of the reportable segments is only 65%. In this case, additional operating segments shall be identified even if they do not meet any of the 10% quantitative thresholds. To achieve this, 2 or more operating segments may be aggregated into one reportable segment. However, the operating segments to be aggregated must have similar economic characteristics and share a majority of 5 aggregation criteria. Assume that segments 7 and 8 have similar products, similar production process, similar marketing method, and are not operating under regulated environment. Accordingly, segments 7 and 8 can be aggregated as one reportable segment to achieve the 75% threshold seen in this table wherein segments 7 and 8 are combined 6% plus 5% equal to 11% and then added to the segments 1, 2, and 3 which are 30%, 20%, and 15% plus 11% with a total of 76%. Thus, the remaining segments 4, 5, and 6 shall be considered not reportable and lumped in the other segments category. If the management judges that an operating segment identified as a reportable segment in the immediately preceding period is of continuing significance, information about the current period, even if no longer meets any of the 10% quantitative thresholds for reportability. If an operating segment, on the other end, is identified as reportable segment in the current period in accordance with the 10% quantitative thresholds, segment data for a prior period presented for comparative purposes shall be restated to reflect the newly reportable segment even if that segment did not satisfy any of the quantitative thresholds in the prior period. However, prior period segment information shall not be restated if the necessary information is not available and the cost to develop it would be excessive. Next, we will now proceed to the information to be disclosed for each segment. So an entity shall disclose the following for each reportable operating segment. First, the general information about the operating segment. Second, the information about profit or loss, including specified revenue and expenses included in the measurement of profit or loss. Third is the information about segment assets and segment liabilities in the basis of measurement. And fourth, reconciliations of the totals of segment revenue, segment profit or loss, segment assets, segment liabilities, and other material segment items to corresponding items in the entity's financial statements. An entity shall disclose the following general information about an operating segment. 1. Factors used to identify the reportable segments. For example, whether management has chosen to organize the entity around differences in products and services, geographical areas, regulatory environment, or a combination of factors, and whether operating segments have been aggregated. Number 2. Type of products and services from which each reportable segment derives revenue. Here is an example of disclosure about type of products and services. An entity has 3 reportable operating segments, namely car parts, motor vessels, and software. The car parts segment produces replacement parts for sale to car parts retailers. The motor vessel segment produces small motor vessels to serve the offshore oil industry and similar businesses. And the software segment produces application software for sale to computer manufacturers and retailers. Next is the disclosure of profit or loss, assets, and liabilities. An entity shall disclose a measure of profit or loss under all circumstances. However, an entity shall disclose a measure of total assets and total liabilities for each reportable segment if such an amount is regularly provided to the chief operating decision maker. Here is an illustration about the disclosure of profit or loss, assets, and liabilities. An entity provided the following financial information relating to one of the reportable operating segments. Sales external is 60,000, internal 10,000 with total sales of 70,000, less cost of goods sold resulting to a gross profit of 40,000, added the interest revenue of 3,000, less the distribution cost of 8,000, administrative expenses of 4,000, doubtful accounts of 1,000, employee benefit expense of 500, depreciation and amortization of 2,500, interest expense of 2,000, and impairment loss of 5,000 resulting to a profit of 20,000. The total assets is 60,000. Addition to non-current assets is 8,000. Carrying amount of non-current assets sold is 5,000, and the total liabilities is 20,000. So, the minimum disclosure relating to the reportable operating segment shall include the following: the sales external 60,000, the sales internal 10,000, interest revenue 3,000, depreciation and amortization 2,500, interest expense 2,000, impairment loss 5,000, profit or loss 20,000, total assets 60,000, addition to non-current assets 8,000, and total liabilities of 20,000. Other items disclosed are specified in PFRS 8 and are disclosed only because these are included in the measure of profit or loss, measure of total assets, and measure of total liabilities reviewed by the chief operating decision maker. It is important to note that the impairment loss is disclosed only because the amount is deemed material. Next is the reconciliations. An entity shall provide reconciliations of segment amounts and amounts shown in the entity's financial statement related to all of the following. Number 1. The total revenue of all reportable segments to the entity revenue. Number 2. the total profit or loss of all reportable segments to the entity profit or loss before income tax expense and discontinued operations. Number 3, the total assets of all reportable segments to the entity total assets. Number 4, the total liabilities of all reportable segments to the entity total liabilities. And number 5, the total for every other material item of information disclosed by the reportable segments to the corresponding amount for the entity. Here is an illustration. The Implementation Guidelines 3 of PFRS 8 provided the following suggested format for disclosing information about reportable segment profit or loss, total assets, and total liabilities. In this illustration, the chief operating decision maker decided not to allocate income tax expense to reportable segments as a measure of profit or loss. The entity has 3 reportable segments, namely software, electronics, and car parts. The other segments which are not reportable include a small property business, equipment rental business, and warehouse leasing. Inside the table are the needed information for the reconciliations. The following reconciliations are necessary. For revenue, revenue of reportable segments 39,000, which is computed by adding the revenue external of software 12,500, electronics 17,000, car parts 5,000, and the revenue internal total of 4,500 equal to 39,000. The revenue of non-reportable segments 1,000 less the elimination of intersegment revenue 4,500 with a total of 35,500, which is the entity revenue shown in income statement. Profit or loss. Profit or loss of reportable segments 4,000. Profit or loss of non-reportable segments 100. Elimination of intersegment profit less 500. Unallocated amount litigation settlement received 500 less the corporate expenses of 750 with a total of 3,350, the entity profit or loss shown in income statement. Next is the total assets. Total assets of reportable segments 79,000, total assets of non-reportable segments 2,000, unallocated corporate assets 1,500 with a total of 82,500, the entity total assets shown in statement of financial position. Total liabilities. Total liabilities of reportable segments 44,000, total liabilities of non-reportable segments 200, and the unallocated corporate liabilities of 5,000 with a total of 49,200, the entity total liabilities in statement of financial position. The change in internal organization. If an entity changes the structure of the internal organization in a manner that causes the composition of reportable segments to change, the corresponding information for earlier periods, including interim periods, shall be restated. However, no restatement is made if the corresponding information for earlier periods is not available and the cost to develop it would be excessive. Entity-wide disclosures. These are additional information that is required to be disclosed by all entities if such information is not provided as part of the reportable segment information. An entity shall disclose information about the following: A. Information about products and services. B. Information about geographical areas. And C. Information about major customers. First, in the entity-wide disclosures is the products and services. An entity shall disclose the revenue from external customers for each product and service. Next is the geographical areas. An entity shall disclose the following geographical information. Letter A. Revenue from external customers in the entity's country of domicile and in all foreign operations in total. And letter B. Separate disclosure of material revenue from external customers in an individual foreign country. And last in the entity-wide disclosures is the disclosure about major customer. A major customer is defined as a single external customer providing revenue which amounts to 10% or more of an entity's external revenue. The entity shall disclose the fact of reliance on major customers, the total amount of revenue from major customers, and the identity of the segment or segments reporting the revenue. The entity is not required to disclose the identity of the major customer or the amount of revenue that each segment reports from that customer. For better understanding, here is a sample of segment information showing the geographical and by products information of example corporation for the year 2020 with comparative information for 2019.